Are you missing a 20% deduction on rental real estate? Many do. And it's missed because these rental activities are classified as passive. However, there's a safe harbor. In this video, I'm going to tell you what that rental deduction is, and I'm going to tell you how you can apply for it. So stick with me. Rental income is usually reported as passive. We all know that. Under the current tax rules, real estate's not treated as a trade or business. And this deduction I'm talking about, qualified business income deduction, QBI, it applies obviously to business income and income of that nature. That's easy. But do you miss it on your real estate? Because it's passive. A lot do, and I find it. The IRS has established guidance regarding whether or not you can treat this as QBI income, qualified business income, which then you get a 20% deduction. Let's start with a story. I got a message from someone who wanted me to review the tax return. I agreed. I reviewed the return and spoke with the client, and I saw she had a storage facility. And she was complaining to me during our conversations about fixing a gate, an automatic security gate, how much time her husband spent out there and how much time she spent chasing money. And all of this prompted me into this, hey, she's actively managing this. She's a material participant. So I looked at her return, went straight to the QBI deduction, nothing there, because the prior preparer didn't know about this safe harbor. And we're going to go back and amend tax returns for this, actually. Active involvement, more than 250 hours in a rental activity, means you materially participate, and you may be able to take the QBI deduction. So, let's look at something. Let's look at this. How we saved our client $1,800, $1,817 to be exact. They owned a self-storage facility. They reported the income as passive income. It was rental, that's obvious. No QBI deduction. When the conversation ensued, I was hearing everything from fixing gates, we chase money, we send out invoices, we do whatever. Material participation, active participation. I said, how much time do you spend doing that? And, there went the conversation. She spent a significant amount of time doing that. We easily got to the IRS's minimum requirements for this safe harbor rule with passive activities. Here's her numbers. Gross rents were $63,000. Net rental income. This is really what matters. Many of you with net losses, this won't benefit you at all. She had significant net income. And you think $40,000, that's not that much money, but yeah, it is when you see the results. What we did was we applied RevProc 2019-38. Go look it up. It's a rental safe harbor election. We made this election. We documented the time spent. We confirmed there was no triple net lease. If you don't know what a triple net lease is, look it up. Basically, that's where tenants pay repairs, taxes, things of that nature. The owner actually doesn't. The tenants pay all of those expenses. That wasn't the case here. Not a triple net lease. We've reconstructed to meet that 250-hour service log. That was easy. Trips to and from, they don't count, but the time spent there does. We filed the required safe harbor statement. All that was great. There's the result. Resulted in a QBI deduction of $8,259. Federal tax, in her instance, saved $1,800. So you think it was worth that $500 for me to go through and review returns? Yeah, I think so. what is that going to save her when I go back to the year prior and we reconstruct and amend? And the year prior to that and we reconstruct and amend? Yeah, I think it was. If you have profit from your rentals and they are active, you materially participate, you spend 250 hours a year, you keep separate books and records, it's purely rental use, it has no personal element whatsoever. So your vacation properties, that's out. You may qualify. There are more requirements, and your situation will be specific to you. So don't take this as personalized tax advice. I say it a million times. This is to arm you with the proper questions to talk to your professional, and hopefully you're getting guidance. That's my point with the very end of this. Why this matters, why advisory matters. If you're taking your tax forms into your professional and they are simply administrative and they fill those forms out, they don't offer you advice, and many won't. I don't. There are so many clients that I have that view me as simply an administrative person to fill out their paperwork. Okay. I can't possibly know all of the questions to ask about your daily life. But if we're on advisory services, then I am actively engaged with you monthly, weekly, quarterly, whatever it may be. This is why advisory matters. If you're still with me on this, I appreciate it, because this will make you engage in a better relationship with your professional. Year-end prep, we look backwards. You record history rather than writing history. When we look forward, we're able to plan and we're able to change things and reduce audit risk and make sure you fall within the safe harbor rules, all of those things. So seek advisory services. Quit paying for an administrator. Please. If you own real estate, you may be leaving this money on the table. Comment. I'll be happy to tell you quickly whether or not I think you qualify or don't qualify. Then we can dig from there. If you have questions about this deduction, just comment. We'll get to the bottom of it. All right, so that was a breakdown of the QBI deduction. I hope you found some value in this. Thanks for watching.